Hello and good day, everyone. We are pleased to welcome Padmashree Crasto, Partner in Audit and Assurance, MSKC and Associates, and Asha Murali, Partner in BDO India LLP, to help us navigate the accounting and actuarial aspects on the insurance landscape in today's session of Insync with BDO India. Thank you for joining us, Padmashree and Asha. Over to you, Padmashree, for the first part of the session, after which Asha would take us through the latter part of this session.
Hi, welcome back to Insync. Today we are going to briefly touch upon IFRS 17 insurance contracts. Of late, there has been a lot of discussions on IFRS 17. Though a small session is inadequate to cover the entire IFRS 17, we are going to make an attempt to briefly cover some of the applicable deadlines as well as some of the basic concepts of IFRS 17. IFRS 17 was first issued on May 2017. The effective date of this standard worldwide being 1st January 2023, and then the comparative period thereon begins from 1st January 2022. In India, the adoption date is notified by IRD as well as MCA. We will look at the details of the date and the approach note therein. This standard is not only relevant for insurance companies but also for non-insurers. It is very necessary to adopt IFRS 9 and IFRS 15 on or before the application date of IFRS 17. We will look at how these are going to impact the financial statements. Equivalent standards in India are Ind AS 117, for which we are going to talk about the implication or the application dates. So, what is IFRS 17 or equivalent Ind AS 117? This standard is very different as compared to IFRS 4 earlier we had or Ind AS 104. This has significantly affected insurance companies or going to affect insurance companies. The scope of IFRS 17, the requirements of this apply to insurance contracts, wherein there are some exceptions, and in some cases the corporate entities where it is non-insurer also may end up issuing insurance contracts, and then it falls within the scope of IFRS 17 requirements. Now this IFRS 17 issues, that it looks into a consistent measurement model for insurance contracts, including the requirements concerning measurement, wherein will be a requirement of fulfillment of cash flow, current discount rates, and also the recognition of profit over the coverage period. Identification of whether a contract is falling within the scope of insurance contract is very necessary to move ahead with the recognition and measurement criteria. Having said that it is important for us to understand the insurance contracts, let's understand what are insurance contracts. Insurance contract is a contract where one party, which is the insurer, actually is going to honor his contract with another party based on the insurance risk, that is the policy holder and the insurer, the relationship between the policy holder and the insurer, and where he is ensuring an uncertainty of a future event, which is called an insured event. So insurance companies and the insurance business per se comes with typical terminologies and typical kind of definitions. So it is very necessary for us to understand these specific matters so that we understand the implication of the insurance contract appropriately. Now, what is insurance risk or the insured uh, underlying insured basically? Insured risk is the risk that is other than the financial risk. Now, to understand that, what is the financial risk? Financial risk is, we all know, it's change in the interest rate, change in the financial instrument prices, the commodity prices, the underlying stuff, and so on and so forth, the credit indices and various other variables. Whereas insurance risk is insuring a certain Whereas insurance risk is actually a certain coverage to the unforeseen or the futuristic event. the whole precinct of insurance business is based on protection of policy holders' interest. IRDAI, which is the governing body in India for all the insurers, actually works on the precinct of or on the basis of protection of policy holders' interest. So it is very necessary for anyone who is entering into an insurance contract, that is the insuring company, to ensure that the protection of the policy holder is adequately undertaken, because all the regulations, all the policies of IRDAI are in relation to the specific insurance contracts, and which are in line with the policy protection of policy holders interest. Let us understand what are the types of contracts to which IFRS 17 basically applies to. IFRS 17 applies to all types of insurance contracts, reinsurance contracts. So reinsurance contracts are basically where the insurer is reinsuring his risk, and certain type of investment contracts with certain discretionary participation features if the entity also issues insurance contracts. What does that mean? That means if the entity is already issuing insurance contracts, then there are certain investment contracts that the company also enters into, and these are they which has certain discretionary participation rights. So this will also get covered by IFRS 17, which comes under the scope of IFRS 17. Also, certain financial guarantee contracts, in case the entity has asserted that it regards such contracts as insurance contracts, then it will get covered under IFRS 17. Otherwise, these kind of financial guarantee contracts are largely governed by IFRS 9, and it will be treated in accordance with the financial instruments accounting recognition measurement, so on, that it is required under that standard. Also, certain service contracts, uh, for example, separately priced warranties, consumer goods that are serviced by third parties rather than the manufacturer. Those also can get covered under the insurance contracts if they have those features that are actually forming it or making it as part of these insurance contracts. Otherwise, it all falls under the scope of IFRS 15 revenue recognition. Now let us look at certain scope exclusions of IFRS 17. We just now had a look at what all gets covered into IFRS 17. Now let us look at few of the things that doesn't get covered under IFRS 17 and how they will be accounted for. That means under which standard they will be covered. First of all, we talked about warranties provided by third parties. So that gets covered under IFRS 17. And if they have those certain types of terms and conditions. If the warranty is provided by the manufacturer, dealer, or the retailer in connection with sale of goods to the customers, then that will be accounted in accordance with IFRS 15, which is like revenue recognition from contracts with customers. Now, residual value contracts, which are again provided by the manufacturer, dealer, retailer, and also, lessee residual value contract. These things again will be covered by IFRS 15 or IFRS 16, as the case may be. These don't fall under the scope of IFRS 17. Financial guarantee contracts, we already spoke about that. Unless it is falling into that specific category that we spoke about under IFRS 17, all other financial guarantee contracts will be specifically covered by IFRS 9 and not by IFRS 17. Contingent consideration. So we have a lot of contracts, business combinations where there will be contingent considerations that are receivable, payable by the entities. These do not form under insurance contracts, and these are specifically covered under IFRS 3, which are business combinations. Insurance contracts, when entity itself is a policy holder, even though the company is an insurer, it still can have some insurance contracts which it has taken for insuring certain interests. So in those cases, it will not be accounted for in accordance with IFRS 17 unless that contract is something that it holds a reinsurance for. So then it will be getting covered under IFRS 17. Further, fixed fee service contracts, these will not be covered under IFRS 17. These will be in accordance with IFRS 15. only in certain criteria being met, then it will get covered under IFRS 17, but it is a very rare case in case of a fixed fee service contract getting covered under IFRS 17. Credit card contracts, wherein they provide insurance coverage, and also that entity doesn't take the obligation. There is a third party or the insurer who is taking that obligation, then it will not be getting covered under insurance contract, that is IFRS 17. It is largely covered by IFRS 9 here. Loan arrangements, for which only insurance component is for the settlement, or some or all of the obligations are being settled. This again may or may not be a IFRS 17 thing, because if the insurance obligation is resting on the entity, then the portion of which can be covered under IFRS 17, otherwise it will be largely under IFRS 9. Now, talking about measurement, for the purpose of measurement, insurance contract measurement will be on the basis of cash flows remaining after non-insurance components are separated. So if you look at the whole portion, the red portion, which is actually the insurance contract, will be something that will be covered by IFRS 17, and the rest of it, when we separate the cash flows that are remaining for non-insurance components, which may be like a specific embedded derivative, which gets covered under IFRS 9 accounting, distinct investment, which again gets covered under IFRS 9, distinct good or non-insurance services, which can get covered under IFRS 15. So these portions will be separated, and then the insurance contract will be purely something that is actually getting recognized with respect to the insured risk. This is a very basic way of or the aggregation or accounting of the IFRS 17 insurance contracts. How do we want to step by step proceed is that, one, we have to separate the profitability, the insurance contracts and their profitability by portfolio group of contracts. We get into three steps of aggregation of or grouping of insurance contracts for the simplicity that we call. Number one, assigning an insurance contract to a specific portfolio on the initial recognition. So, it can be a different product portfolio like a vehicle insurance contracts or the life insurance contracts, specific period contracts or product insurances. So we have to, make kind of a grouping of these insurance contracts for the purposes of accounting. Then the next thing is that dividing that portfolio into at least three groups according to the minimum requirements of IFRS 17. Now again, I would like to touch upon that this is a very basic concept that we are discussing. Obviously, there are hours and days of discussions that we can have on how a grouping has to be done, how a portfolio has to be culled out, how the separation of the three groups have to be made. Now, what are these three separate groups that we are talking about? Number one, contracts that are onerous at the inception itself, contracts with no significant possibility at becoming onerous subsequently after initial recognition, and other remaining contracts that are basically, you can call them as like profitable contracts. Also, we have to evaluate it on annual basis, because it prohibits that if you have already issued something and if it is more than 1 year, then you cannot regroup unless you evaluate. So there has to be a strong basis on which you will evaluate and group them again. Coming to recognition, when do you recognize the insurance contract? A group we talked about will make specific groups based on, types and portfolios and things like that. So group of insurance contract has to be recognized at the earliest of the following three dates. Either at the beginning of the coverage period, or when the date of payment from policyholders become due. In case the contract do not have a set date, then when the first payment or the premium is received therein. And for the groups of onerous contracts, the date when the group becomes onerous or loss making. It is to be noted that it is earliest of these three dates and not the latest of these three dates. So any trigger of either of these dates will actually make the recognition, will meet the recognition criteria. Now let us look at the different measurement models for different types of insurance contracts. Now these are very detailed approaches, models, and it takes days and months to calculate and adopt these models. but here giving a very brief idea of the same. A general measurement model, it largely applies to all the insurance contracts which are in the scope of IFRS 17, except in case where the premium allocation approach or the variable fee approach, which we will look into, will apply. This is also adopted by reinsurance because this is quite straightforward, and this is used by life insurance. In case of life insurance, because it is entered into long term and the benefits and everything flows over a period of time, this is the way, this is the model that is built to actually recognize income over the period of time. Now, this is the biggest difference as compared to IFRS 4, which was the existing standard. There we used to recognize the premium upfront. Here we are going to recognize the premium like on the basis of the time value of money, or the model of the flow of the income over the period of time, and not as a case of upfront recognition. Premium allocation approach. This method actually simplifies the measurement of the liability for remaining coverage. PAA is generally available for group of contracts when coverage period for all contracts is a year or low. So this largely applies to the general insurer, where the general insurance is like a motor insurance, health insurance, where there is a fixed period, that is like the insurance contract is for a period of 1 year, and the expectation is reasonable. The reasonability of expectation is that the PAA will produce measurement of liability for remaining coverage period for the entire group, and then that will not be materially different from the general model. So then the PIA method gets used. Largely this is used in general insurance. Variable fee approach. Now this is something that is largely used for contracts wherein there is a variable annuity equity method, linked method. So here, as the name suggests, a variable fee model is a little bit based on measured based on the obligation to pay to the policyholder, which is actually an amount equal to the underlying item, and which is net of consideration. So these are largely for the direct participating contracts. Now, participating contracts are like, always in contracts, there will be two types of contracts. One is participating, non-participating. Participating is when they will get a portion of whatever is the company also is earning. So significant profit share or some additional bonus or something that will be allocated to them from a clearly identified pool of underlying items. So this approach becomes useful. Variable fee approach becomes useful in case of those kind of contracts. And these three distinct models are significantly different, and they take a lot of time to calculate and then to determine what is the type of model that I'm going to use for the group of insurance contracts. It is very important. Once we decide, then actually all the other calculations and all the rest of the things follow. We spoke about the recognition. Now we spoke about now we will speak about the modifications to the insurance contract. So there is a list of conditions based on which you can determine whether it is a substantive modification or otherwise. Uh, in case of modification, if either of the party actually modifies the insurance contract, and which is substantive in effect, then the entity can either de-recognize the original contract if the modification is too substantive, and then recognize the modified contract as the new contract from that period. When will you de-recognize the contract? When the contract period is over, that is, it is extinguished and the obligation is fulfilled, and the conditions for substantive modification is met, as we discussed. Presentation and disclosure. Accounting policies, starting with the accounting policies, because of the change from IFRS 4 to IFRS 17, there will be a lot of changes to the accounting policies, adoption of the correct model, grouping of the insurance contracts, assumptions. So there will be lots of the notes will go into more detail. There will be lots of details that will be put in the notes to accounts. Basic additional presentation or disclosure is the way it is presented in the financial statements. Changes the terminologies, changes the grouping, changes in the financial statements. Additionally, we spoke about the uh, accounting standard implications, that is the detailed accounting policies that we have to give, then the groups that we have determined, significant judgments in applying IFRS 17. Needless to say that in choosing the model, in developing all this, in changing the systems and processes, Actuarial assumptions play a very important role, and actuaries play a very important role. So we have to give the detailed assumptions and detailed changes in methods and implications thereon, and the reconciliations as such. Also, the details of the nature and extent of risk and reinsurance has to be disclosed as well. One of the important things is that IFRS 17 has to be applied retrospectively. Why this actually happens is that insurance is not a stagnant thing. It's a over a period of time. For example, life insurance is for the life. So there are 10 years, 20 years, 50 years up to the life premium is being paid. So unless it is impracticable, uh, it has to be IFRS 17 has to be adopted retrospectively, and then the net impact being charged to the equity, and at the beginning of the comparative period. If it is impracticable for an entity to adopt IFRS 17 retrospectively, then it can apply modified retrospective approach. There are certain leeways, and there are certain exemptions that are provided by the standard. So several simplifications are provided for the initial application. Example, charging of the CSM, insurance finance expense, and things like that. Or it can use a fair value approach. So there it has to determine the CSM or the loss component at the date of the initial application, and then it has to calculate the difference between the fair value of group of contract and the fulfillment cash flows, and then it can be accounted for in accordance with the same. Coming to the most important aspect of Ind AS 117, when it is getting implemented in India, what is the date on which IRDA wants the insurance companies to actually apply IFRS 17 or the Ind AS 117? Ind AS 117 has only certain carve-outs based on Indian markets. The notification of Ind AS 117 was actually came into effect on 12th of August 2024. MCA issued this notification. Subsequently, MCA had issued saying that this will be applied from 1/4/24. Now that notification is withdrawn. IRD has issued its approach note on 30th September 2024 based on the past history, wherein NBFCs and other financial companies were in the phased manner of approach of Ind AS application. IRD has also come up with a phased manner of implementation of IFRS 17 or Ind AS 117 as the case may be. So Ind AS compliant financial statements, the pro forma financial statements have to be prepared in accordance with three phases. The pro forma financials will be first prepared on Feb 25 for FY 23-24. Pro forma financial statements for 24-25 will be prepared by phase 1 companies for December 25. Now I'm not going to the listing of which companies fall into phase 1, phase 2, phase 3. The listing of the phase wise companies are provided in the appendix to that approach note. Certain important things or points to be noted from the approach note. This pro forma financial statements should be prepared in compliance with the applicable Ind AS 117. Insurer has to disclose and document the assumptions in the pro forma financial statements. So this was actually very challenging. So the insurer will also provide certain gap assessment, and when those gaps will be actually simplified version of the when those gaps will be covered up by them. IGAP financial statements will be considered as the financial statements for all legal purposes or for all the filing purposes until the Ind AS 117 doesn't actually come into effect completely. This pro forma financial statements has to be signed by the appointed actuary and the CFO of the insurer. Uh, Further, the approach note also encourages the pro forma financial statements to be subjected to limited review or audit by independent chartered accountant or by and independent actuary as well. Relaxation in the timelines for pro forma submission of this has will be provided in case a new insurer is there or commencing business just from calendar year 24 onwards. Insurers who are already in the phase 2 and phase 3 are having an option of early submission also in case they want to do so. Ultimately, the endeavor of IRDAI to bring in Ind AS 117 is from 1st April 27. So this pro forma and building up all these features will be something that will be very interesting phase to understand and smoothen out or iron out all the differences in these matters.
We will now talk about the implementation approach. Now that we have an understanding of the standard, let's talk about how the Indian insurance company uh, will be implementing IFRS 17. So there are some companies which have already started the implementation journey, while there are others who just embarked on this journey. Implementation of IFRS 17 is a complex process that demands careful planning and execution. It's a very resource-intensive exercise. Even with careful planning, companies should be prepared for uncertainties and should be budgeting for this in terms of time, resources, and money. The first step is, of course, to identify what are the different gaps in the data, processes, and systems, and of course, skilled personnel. Now, the gaps could be in terms of understanding itself of the standard and having the requisite number of people, because you'll also need to do your BAU. So most companies look for external help in carrying out the IFRS 17 implementation in order to bridge the gap of skilled personnel. The next step is, of course, to arrive at policy choices in conjunction with impact assessments. Then you arrive at a target operating model which takes into account your IT architecture, your data models, interactions of various systems, and therefore identification system which will let you produce IFRS 17 numbers. However, one thing we should keep in mind is that the fundamentals of the business do not change. And whatever information is required for taking key decisions are still available. IFRS 17 will provide us with a lot of granular information, but it should still be possible to filter out the relevant information for management to take relevant decisions. It's also a good opportunity to enhance understanding of the business and bring in operational efficiencies. Having the right data will prove to be the biggest challenge that companies will encounter as they start the implementation. The level of data needed is granular as compared to the current gap. There is a requirement to go back in time right to the inception of the contracts. This could be something like 15, 20 years or even longer, and gather relevant data. So availability of historical data will decide on the transition approach. A practical approach would be to have different transition approaches to different portfolios based on the availability of data. So you could, if data is not available, you could then do a modified retrospective approach or a fair value approach. Most insurance companies have a data warehouse base which they use for their in reporting the financial numbers. Now, of course, this data mart would have to be enhanced with data from different source systems. It's also important that we carry out reconciliation so that we know where is the right source of data, which is the correct data. Now, another difference from the current gap is that now the source system will also include outputs from actuarial models. So now the data gaps have to be addressed by updating your best estimate liability models, developing cash flows if these are not available, including reinsurance cash flows. Of course, the ultimate data model which you will be choosing will depend on the technology which has been chosen. However, in the interim, it's important that we gather the data, test the quality of the data, have data validation rules, and also have data flow charts, because we should know from where the data is flowing. And of course, a data governance framework has to be developed in order to make sure that the data which is used for IFRS 17 numbers is correct. We now move on to the next step which we need to do in order to go ahead with the implementation of IFRS 17, and that is policy choices. Now, IFRS 17 is a principle-based standard, and there are a lot of choices which are given. Right? There's nothing which is said that you need to do this in this particular way. So it is important that as management, the right choices are taken. because it's going to affect your KPIs, it's going to affect the different trade-offs that you would have to do, like whether your network is going to change, whether your future profits are going to change, whether your CSM is going to change. These are decisions which need to be taken, and of course, in order to exercise these policy choices, you would need to have the impacts. So there is a bit of it's a bit of an iterative activity. You will look at the impacts and then you will say this is a choice that I need to take. It also depends on the business profile of the company. So the key policy choices are, of course, the level of aggregation, uh, how you manage the business, correct? And what's profitable, what's not profitable, at what level of granularity will you say it's profitable or not profitable, how you approach your discounting, the risk adjustment, whether you go to calculate risk adjustment at an overall level and then allocate it to different lines of business, or calculate it at a granular level, what could be the offsetting impacts of the risk adjustment. And also if the measurement, like for like the measurement model, whether a particular type of portfolio is eligible for a PA or it is GMM. These are some of the decisions which need to be taken. The other key decisions are the contract classifications. For some time, maybe you will also have to unbundle some of the contracts if there's a significant investment component or a service component, and the contract boundaries. Now, once these policy choices are exercised, it is extremely important that we document them, because this will serve as a basis of implementation, and it will also help with discussion with the auditors. So now you have your data and now you have your policy choices. You also have your existing system architecture, then IT infrastructure and architecture. We have a gap report which tells us where we are and we know where we need to reach. So we need to now arrive at a new IT architecture. So of course what you have is something which you should be leveraging if possible, reusing existing system capabilities, understand current architecture to identify solutions. Then of course the data considerations, the flow of data, the volume of data, and how do you want the data to flow. That will also define, the architecture will decide the data, but if you have data in a particular format, now whether to take the cash flows and then calculate the CSM engine, and then feed it into the CSM engine so as to calculate the CSM, or have a much more wider model which probably calculates the CSM itself and the cash flows and then the CSM. The process considerations, how fast you want, how do you want to automate, what is the audit trail you want, what steps do you want to intervene, do you want to check in between whether everything is going right, or you want to check at a particular point in time, any customization that you need to do, because you might because of the way you run your business, or there could be some group reporting. So that will also require some customization. Of course, the quality of the data and audit trail. So these are all things which will go into the target operating model and the architecture. So at this stage again, there's a requirement for a lot of documentation so that the implementation becomes smooth. So we have the existing architecture and you have the new identified architecture. So you will have a system overview, you know what are the flows of data from different systems from one to the other. So there's the different points at which there has to be an integration between the different systems. And then you write up the solution document as to how all of this data flow happens. And then for the implementation of the system, you'll have to now have a business requirement document. What is it that the system needs to calculate, and what is it that we are looking as an output from the system at different stages. And of course, this is a requirement for for the implementation, you'll also have to write a much more detailed document from a technology point of how do you implement it from the so that the technology vendor understands what is required. So what are all the requirements, what are the system requirements, and what's the data flow requirement? These are some things which get specified in the functional specification document. So again, I would like to stress the documentation is the most important thing, because this will ensure that the implementation happens efficiently, there is enough audit trail, and there is, when all those involved with the project will know what to expect from the implementation. So once all the specification documents are required, we'll go ahead and do the actual implementation. So there'll be a lot of data which needs to be fed, and therefore there's going to be transformation of the data which is needed. Then of course the actual configuration system to meet the requirements of the which have been spelled out in the functional specification document. And once this implementation is done, it is very important that we carry out the testing and reconciliations. So the design of the test cases has to be done very intelligently in order to make sure that all scenarios are captured correctly. You will have to build in parallel models in order to make sure the results which are coming from the system are accurate. And then of course you will have to maintain a defect log, feed it back to the people who are implementing, test again, and then make sure that the ultimate output that you're getting is correct. And of course, so now you're doing things in compartments. So you're first looking at the data enhancement, you're making sure the data is transformed, and you build the data model, you transform it, and you feed it in system, calculations are happening. You check the accuracy of the calculations. It's also important that the whole process works, so the whole flow is something which is which can work smoothly. For that, you will carry out parallel runs. So you may do it for a few quarters in order to make sure that the numbers are that the whole process is well defined and the numbers are correct. Of course, there has to be enough audit trail also for everybody, for the management, for everybody to have, and the auditors to have enough confidence in the results. So once the implementation is complete, of course, you'll go live. But it's very important that, again, at this stage also, that you document the processes which you're going to follow, because that is going to be BAO and future, and there should not be any steps which get missed out, or which are done erroneously, which will result in an impact the numbers. And of course, as and when you go ahead, you'll keep on monitoring the process to make sure it's still efficient and it's still is giving you the right results. The standard itself may undergo change. You'll have to make enhancements for those. And these are some things which you'll be doing, of course, on an ongoing basis. Now that the implementation is completed, we need to communicate the results. As we discussed, this is a collaborative effort across different teams. It is important that the actuarial and finance teams understand the results completely, but it's equally important that they communicate the results to key stakeholders as soon as possible. And this is something which needs to be allowed for in the implementation plan. While a discussion with auditors is supposed to happen parallelly, discussion with management and the board has to be done, and it has to be focused on before the results are published externally. Everybody has to be comfortable with the results, because they'll have to now own up these results and communicate them. Now, IFRS is expected to bring transparency, and the implementation will provide more business insights. It is up to the companies how to make use of these insights, and it's also an opportunity to understand the business and change strategy if required. And an important decision that we need to make will be what will be the metrics going forward. It will be IFRS 17 related numbers, and also the implementation should address that going forward these metrics are something which can be forecasted and can be tracked. Good luck with the implementation. Thank you.